Why diversification is diversification. Charlie Munger once said diversification is insane. Warren Buffett called it protection against ignorance. Think about it. The one thing every financial advisor says you must do, both Buffett and Munger are calling nonsense. What if diversification is the real risk? We'll unpack why the world's best investors reject diversification and how rethinking it can change your investing forever. So, let me explain why diversification is bad for investors. It's kind of like going to a restaurant and looking at a menu. Imagine being given a menu with only four items: a vegetarian choice, a fish, chicken, and beef choice. Well, it's just really a matter of what you're in the mood for and you order it. Now, imagine at the same time you're given a menu with over 300 things to choose from, and it takes you 10 minutes to go through and start browsing through to find what you're interested in. Often you're just going to turn to the waiter and ask, well, what does the chef recommend? Or what do you like the most? Because it's just too many things to choose from. Well, in the same way, there's too many moving parts in a portfolio. Hundreds of small positions flashing green and red, showing you daily profits and losses, is overwhelming. Most investors are helpless in making any decisive decisions to buy or sell. The first thing they teach you in a CFA program or finance class is modern portfolio theory and diversification to reduce risk. What they are really talking about is volatility. But volatility isn't just a risk. Volatility is also opportunity for real returns. So I have a chart here to compare this. First, on the black line at the bottom, that is showing the returns of the S&P 500 equal weight index, just a basket of diversified stocks against that of the Mag 7. So some investor that had, let's say, a high conviction that the AI story was going to be great, and they put all their eggs into one basket. What is clear is that they, with that conviction, they were able to materially outperform that of someone who just held this diversified basket. What it really comes down to is that the illusion of safety and diversification replaces real analysis and deep conviction. So on this chart, I wanted to compare passive versus active indexes. What you can observe here, the in blue is the 6 basis point fee for a index fund versus that of a 227 point fee on an active fund. Over the long term, the fees make a difference. And it wasn't just a small amount. What you can observe here is that the active fund, the fees dragged the performance that it only grew to $100,000, while the very low fee index approached almost 200,000, a doubling of the account. And this drag is literally only caused by the fees. So when does diversification actually make sense? Investors dumping money into a pension while working full-time jobs often have no interest in being involved, and giving their money to fund managers managing billions of dollars need diversification, but they are guaranteed mediocre returns, barely hedging inflation. What you have to really ask yourself is, what are you diversifying for? Concentrated positions have risk of material drawdowns. Every investor dreads the thought of losing 50% or more on their investment idea going wrong. What we're looking at on this chart is the cross asset correlation during bear markets. And what you can observe is that when bear markets happen, that correlation rises. And that's the key. Diversification almost always fails when exactly you need it the most. That risk can be completely managed, whether through stops or through using options for risk management. What Buffett and Munger do is simple but hard. Study relentlessly, wait patiently, then bet heavy when the opportunity strikes. My approach: high conviction with a defined risk. I might bet big on a high conviction stock with leverage, but I manage the risk with options. I put a floor on my trades. My favorite way to do this is with strategic option protection. I will often construct a trade with a clear worst case scenario. Now, let's do an example. An investor starts with $100,000 and invests equally into two high conviction ideas: $50,000 into this XYZ stock and $50,000 into this ABC stock. Now, to manage the risk Strategically, the investor buys protective put options, ensuring that their maximum potential loss is limited to 10% on each of the trades. Then the unexpected happens. ABC stock plunges 30% due to some terrible news. But instead of losing $15,000, the protective puts kick in, capping the loss to just 5,000, a mere 5% drawdown on the entire portfolio. Conventional wisdom says concentrating in only two stocks is reckless. Yet, even in the worst case scenario, the investor's careful risk management has resulted in only a modest setback. When the stocks moved strongly upwards, the investor captured significant returns, real impactful gains. Their performance wasn't diluted by dozens of small, insignificant positions cluttering their account. Here's the bottom line: serious wealth creation isn't about owning everything, it's about owning the right things and sizing them meaningfully. Diversification doesn't guarantee safety, it guarantees mediocrity. Real power comes from focus and conviction. If you're interested in learning more about these income strategies, click on the link below for a 14-day free trial to Big Picture Trading. We'll see you all online there.